In previous videos, we've taken a look at the various ways that investment income, such as interest, dividends, and capital gains, are taxed. But if you have investment income and your adjusted gross income exceeds certain thresholds, you may find yourself liable for an additional tax. I'm the Tax Geek, and here is the net investment income tax, oversimplified. To learn about how all the various types of investment income are taxed and how those taxes are reported on your tax return, I've provided a link on the screen to a playlist covering those very topics. First of all, let's look at the types of investment income that may be subject to the net investment income tax. These include taxable interest, both ordinary and qualified dividends, and short and long-term capital gains. Passive activity income is also considered to be investment income. This includes all net income from rental activities, as well as any income you receive for business enterprises that you do not participate in. Income from annuities is also subject to the tax, unless the annuity income is received as part of a tax-deferred retirement plan. The amount of investment income may be reduced by any reasonable expenses incurred to obtain the income. This can include maintenance or transaction fees if they weren't already taken into account by the payer, or interest to obtain investments, such as margin interest. State, local, and foreign income taxes on investment income can also be used to reduce net investment income. These adjustments usually do not reduce the amount of investment income that is subject to regular income tax, but they do reduce the amount of investment income subject to the net investment income tax. The tax itself is a flat 3.8% on all net investment income, or that portion of the net investment income that exceeds the adjusted gross income threshold amounts. These amounts are $250,000 for married couples filing jointly or qualified surviving spouses, $125,000 for married people filing separately, and $200,000 for single or head of household filers. Time for a quick example. Doris files as single, and this year her adjusted gross income was $235,000, which included $15,000 in net investment income. Since her adjusted gross income threshold is $200,000, she would be subject to the 3.8% net investment income tax on the entire $15,000, which comes to $570. Now let's suppose her adjusted gross income was only $208,000, including the same $15,000 in net investment income. Now the net investment income tax would only be assessed on that part of her net investment income that exceeded the threshold, or $8,000. In this case, her net investment income tax is $304. When determining net investment income, losses in one type of investment income can offset income from other types, potentially reducing or even eliminating the tax. In this example, Christine, also single, sold her rental property in October, which generated a $185,000 capital gain. Her rental property also incurred a $3,500 operating loss from January through October. Including both her investment and non-investment income, her adjusted gross income was $415,000. In this case, the $3,500 rental loss can be subtracted from the $185,000 capital gain, giving her a net investment income of $181,500, resulting in a tax of $6,897. The net investment income tax is reported on Form 8960. Let's complete Christine's Form 8960. In the first part, she lists her investment income. On line 4A, she enters the net operating loss from the rental property as a negative number. This figure comes from page 1 of her Schedule E. Then on line 5A, she enters the gain on the sale of the rental property. All her investment income is totaled and entered on line 8 of the form. Any expenses she had related to her investments would be entered in part 2 of the form. Since she hasn't any expenses she hasn't accounted for already on other forms, she leaves this section blank and moves on to Part 3. On line 12, she subtracts the Part 2 total from the Part 1 total. This figure is her net investment income. She then enters her adjusted gross income on line 13 and the threshold based on her filing status, which is $200,000 on line 14. The figure from line 14 is then subtracted from the amount on line 13, and this amount, or the amount from line 12, whichever is lower, is entered on line 15. This is the amount of net investment income that is subject to the net investment income tax and is multiplied by 3.8% to arrive at the tax. The tax is then entered on line 12 as Schedule 2, and this amount, along with any other additional taxes from Schedule 2, is transferred to line 23 of Form 1040. Of course, this is an oversimplified description of the net investment income tax. The instructions for the form run to over 20 pages that cover every possible situation and exception. These instructions, along with additional resources and information on the tax, are linked in the video description. Please like the video if you found it informative, and share it with anyone else who could find it useful. To see all sorts of content on our complex tax system, the best thing to do is subscribe. And of course, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.